Good morning, Mr. Matt Gougé. How are you doing today, sir?
I'm doing great, man. Everything from Thanksgiving is fully digested by now. So back in the office, ready to, get after it in this final month of the year.
Love it. That's more than I can say for myself. I'm still got some apple pie up high right now, but I'm not mad about it. So let's dive right in. I want to start with a recap on last week. So we talked a little bit last week. I know that you were out doing some awesome charity stuff, but what we discussed a little bit is we had some decent news getting into Wednesday of next week, and then a lot of nothing for the holiday and the short market on Friday. So let's go back and see what those numbers turned out, because like I said, there was some big stuff coming on Wednesday. All the Tuesday data was completely flat, nothing really interesting. One thing that did jump out to me though is new home sales. The percentage for October was down 17.3%. Oh, that was interesting. The previous month, it was up 4.1%. So to go from up 4.1 to down 17.3, pretty significant. New home sales October, 0.61 million. It's pretty low. That's a combination of just builders doing what builders do, interest rates, affordability, everything's playing into that. But there was definitely a drop off in October. I think a lot of that was also fueled by the election. You just didn't have a lot of people getting into new home contracts there in October. What did you see as far as new construction? Do you do much new construction in your part of California? What have you been seeing with builders?
Yeah, well, in California, I think new construction makes up almost like a quarter of home sales, so like 25% is new construction, 75% is resale. And that number's grown over the last couple of years. And for me, the explanation I have as a mortgage broker is like builders have learned to solve affordability because they take, a big credit and they buy down the interest rate so that buyers can afford a payment. And they're happy to do it as long as they get their price. And so, builders are still building quite a bit in California. I saw a stat recently, which I thought was interesting, that since 2016, the size of new home builds is down 12%. So not to get us too far off track, but builders are building, and I think they're trying to build relatively affordable, and the data kind of shows that they're not building, McMansions anymore in California, at least where I'm at. But, it's still hard to build something affordable in a lot of markets and most markets in California.
No doubt. And, we can get off track as much as we want to. This is our show, so we can do whatever we want. It's our
we can talk about whatever we want to talk about.
That's right. So, here in Texas, we are home of the McMansion. It is what we do. And I saw that same stat like a year ago. I saw that where the average size of homes have gone down pretty significantly. But like you look over the last 30, 40 years, and the average size of homes has grown, to a massive degree, to the point where like a 2,200 square foot home is small. That used to be huge. And now it's like 3,000 square feet as a starting point for a lot of this new construction. Well, now they're getting back down. They're trying to build 1,900 square foot things. But the bit of data that jumped out to me, and unfortunately, this data was only good as through about 2021 when I saw it, was, can you guess the average price per lot for new construction before any foundation is poured, before they do any kind of construction whatsoever, just the cost of land, permits, insurance, like the baseline cost per lot? What number would you throw out there before construction starts?
Are we talking nationwide? Are we talking
Yes,
Texas?
nationwide.
Nationwide. I think, I'm skewed because I'm in California.
Yeah.
But that number's got to be approaching six figures. It's got to be.
You weren't supposed to be right because that kind of takes all the juice out of my point, but you're a smart guy, so I'll give you credit. $92,000 was the amount of money that was spent before anything got done. And that was really impactful to me because I'm thinking, okay, well, what does it really cost to build a 1,500 square foot starter home? And, why don't we have more $230,000, $250,000 homes here in Texas being built? And I'm like, well, because it costs $92,000 before you start doing anything. And that's why like our new construction starts at like 275, 280. And the problem is you get too small in the square footage, then the price per square foot becomes so high that you can't compete with the resale market. It won't appraise. And that's why we've seen the big drop off in affordability, and, the homes being bought by first time home buyers has shifted greatly. It used to be like 80% new construction because you could go get your Lennar DR Horton home for, at least here in North Texas, 125, 130,000 10 years ago, then 180 to 215. That was a great place to start building your equity, start building your net worth. Now that starts at like 330. And, with our taxes and everything and our insurance here in Texas being ridiculous, that's a $2,600, $2,700 payment that's no longer in line with affordability. But let's move on. Let's keep going on our weekly recap. I was just curious what you saw out there, and I'm going to derail us when I feel like it.
Okay. Yeah. That's a great point. And we could always dive back in because it's a fascinating conversation. Like that's the problem with affordability is like the red tape and all the costs that go into it. But we'll rant on that later.
That's an hour-long rant. We could talk on that forever. So looking at what actually happened on Wednesday, we were talking about core PCE month over month and year over year. We're both going to come in. The PCE month over month for October was projected at 0.3%. The previous month was 0.3%. It came in at 0.3%. Inflation year over year, 2.7, 2.8, 2.8. So we hit 2.8. Previous was 2.7. Expectations were hit. We met expectations in everything. Core PCE inflation year over year hit. Pending home sales hit. Everything hit. So, we saw no major move on Wednesday, but we did on Friday see a pretty significant move in the bond market, which caused yields to improve significantly, where we saw a nice little hit. Now, I know the answer as to why that happened. I'm curious if you know why that happened when there was a no news day.
A no news day and mortgage bonds.
Treasury yields shot down, Treasury prices shot up, mortgage-backed securities improved significantly on Friday. It's a trick question, and I'm just throwing it at you because I can, because you're my friend.
Okay.
But.
Well, I'll tell you what, as a public school educated mortgage broker, I know if I like it, I lock it. So I locked on Friday. I opened things up today. Friday isn't usually the day for the best rates, but rates improved and now give me the answer to why they improved on Friday.
So it's, I don't want to say it's a bad answer, but it's an answer that isn't data driven. It was short covering. So as we got into the end of last week, we had a bunch of people have to go and cover their shorts, which, led to buying back a lot of those shorts that were done in the Treasury markets. And so it shot yields down. Cool. Well, guess what happened on Monday? All those shorts re-entered their positions. So we saw a great improvement on Friday. We saw a pullback today that was not data driven either. We've got some mixed data today. And, I think we lost it started like 30, 35 basis points in the mortgage-backed securities. Now it's down to like 14. So we have softened out nicely, which is great. But it's not based on real data. It's just big money moving in and out, and, those short positions picking back up. So unless you got anything else to add on the end of last week, we can't factor in for short positions very effectively, but I'd love to get into the numbers and start talking about what we're seeing forecast wise, if that's cool with you.
Yeah, let's look at the numbers, then we'll talk about, all the exciting data that's coming out this week. Cause I know you follow that. You got the stuff marked on your calendar for when jobs reports and whatnot are coming out.
I do. I like this stuff. What are we looking at here, Matt?
This is Mortgage News Daily, average 30-year fixed rate. Again, it's conventional. Again, it's, somebody with great credit. So like this isn't an offer to lend or a rate that you're necessarily going to get, but it gives you a feel for the trajectory of rates. And it's rather simple in my mind when you are thinking about the mortgage rates effect on the market. In September, when rates were down near 6%, like I was looking at the chart on refinance applications. And this is something I just want to throw in there in regards to refinance. Like you never know how long the window's going to be open. But the good news is, like as an industry in mortgage, we're getting better and better at moving fast. And so I was like surprised and proud at how many people jumped and took this opportunity where it was literally like a week in time in September, where if you locked between, early September and middle September, you were able to get something low sixes with little costs. Some people spent a little bit and got stuff in the high fives, but I think when data moves slower, circa 1985, people would have just totally missed that opportunity. Now stuff is everywhere, for better or for worse. If you're a consumer, you're going to get bombarded with calls and emails and text messages, even though texts are supposed to be regulated. But if in the future, if you're thinking about refinance, look at this chart and realize that like this stuff ebbs and flows. It comes and goes when it comes to opportunity. And so I just had to throw that in there because I saw that. Another surprising stat was it last week that mortgage purchase applications were up 12%. And not really sure what to attribute that to. I know that I've got buyers that are re-engaged and re-excited because they realize, there's deals to be had in the winter. But why are mortgage purchase applications up 12% towards this late in the year?
Because it's month over month. What was the month before?
Well, I think it might even be the week over week number. What was I looking at?
Week over week would be cool. The numbers that I was looking at and focusing on was the October to November, which posted last week. And I was like, okay, yeah, they're up. But, the last week in October was trash. And like, they're still down a little bit year over year. But again, it's because we just had an election and everyone's got a lot of stuff going on. It's the holidays, it is what it is. But, to your point, hold on. Did you really just reference 1985 as far as slow movement? Were you even alive in 1985?
I was in kindergarten, bro.
Okay. Well, I was one, so I was not paying a lot of attention to the markets in 1985, but I can reference the mid 2000s because I was doing this job then, as well as the mid 2010s. I don't know what we call those, the teens, where we would see these long, slow stretches where interest rates just wouldn't move that much. We're 5.5 forever, and then 5.75, then maybe 5.3, but you wouldn't have any kind of rapid movement on this. That's just not the world we live in anymore. It's such a fast-paced, data-driven cycle that, like you said, when things go low, people are going to act. And I think the common misconception a lot of loan officers and industry professionals have had over the last few years is once things start getting better, oh, well, now it's going to turn. Now it's going to get a lot better. So there were a lot of people in mid-September, I know, that didn't take advantage, that were like, okay, well, it's just give me a little more. Just give me a little bit better. And you take the wins when you can get them, because you can always come back and get more wins in the future. That's why, for me personally, I love writing refinances, but I write them for cheap or free. I'm using lender credits in there to offset costs, because if they do keep going down, you want to take advantage again in 9 to 12 months. Cool, do that. But, don't let the best get in the way of the good. And, you never buy stock at the cheapest. You never sell at the highest. You got to say, okay, what's my savings? What does it cost? Does this make sense? If the answer is yes, cool. We take action and not sit there and be so focused on the absolute lowest and best that we're going to get. Because if you're looking to experts to tell you when that's going to be, obviously I'll pat us on the back. You and I are about as good as it comes when it comes to knowing where these rates are going. All we know is when it's good enough. Like, hey, it makes sense. Let's take action. I can't tell you where things are going to be in a month, a quarter, a year from now, but I can tell you, hey, if you can save $200 a month at a cost of $1,000, you're going to be looking really good as long as things aren't a whole lot better in the next 5 months.
Yep. No, I totally agree. And, you know, I've got countless examples, 2019, 20, and 21. Some people refinanced 3 separate times. Every single time it made sense. Every single time they were locked in case that rate didn't come around again. You know, we had no idea 20 and 21 were coming rate wise. But yeah, lock it at 4.25, save yourself $300 a month, and look at that break even of 7 months. Save it for 12 months. Oh, now we can lock it, you know, 2.99%. And you refinance again. The people that wait for the absolute bottom are like somebody who's still waiting to invest in the stock market and didn't buy a Tesla stock 10 years ago or whatever they were looking at.
You know, the extra money you spend waiting is going to undo any benefit that you have from getting that lower rate anyway. So no, I'm aligned with you. Let's see what else we have on the slide deck here when it comes to numbers. We talked about this a little bit last week. It's really not changed a whole lot as far as target rate probabilities coming for the 18th meeting. You know how I feel about the meeting on the 18th, but give me your breakdown on this, because now we've moved into a 62% stating that we're going to have a cut on the 18th. It's really going further away from my analysis, but you know, I'm okay to be wrong here.
Yeah, I mean, I still think we agree that over the next 2 meetings, 25 basis points total is the favorite. So if like we do it here in December, then we're probably going to take a pause in January. If we don't do it in here, then, you know, they'll have the flexibility to give us 25 basis points in January. I think the problem lies in that, you know, the Fed wants to be trusted. And so once they start talking about a plan and they're going to do X, Y, and Z, I think they stick to it relatively well. Of course, like there's been some changes and we didn't get 6 or 8 rate cuts like people originally thought maybe 12 months ago. But I think this is a safe bet that we get a quarter in December. But truth be told, I don't know if it matters whether it comes now or January. I think, you know, what they talk about, future trajectory of where they see things going, is more important. And then, you know, Jerome Powell will say it. And I don't even want to say it again. I'm so tired of hearing it, right? Like they're going to be data dependent and, you know, it's all going to depend on what comes up. Well, you know, that's what we have to regurgitate because that's the truth. They're going to see, you know, what's going on in the job market, what type of inflation numbers we're seeing, and they're going to go from there. One thing quickly on inflation is we're not going to get these massive improvements in inflation this month or next month that are looking at November and December numbers. January's inflation number, when you start to compare stuff year to year, is a big one. And so it's going to be February when you see any significant data and compare year over year numbers, go, oh my gosh, inflation really has come down quite a bit. I don't remember the exact numbers, but I know that like November, December are small. So you can't have that big of a year over year improvement. And January's is like 3x what December's is. And so, you know, that kind of stuff, you just have to wait and see what the numbers say. And then that's going to, you know, lead the Fed. And then we're going to listen to the Fed and what they say on whether it's 2 cuts in 2025 or 7.
Yeah. And it's going to depend a lot. Let's see what the January target looks like right now. Yeah. I mean, it's still funny enough that it's almost unchanged from the December as far as the number of people that think no cut. You know, we go from 32% to 29.7% on that. Interesting enough. I would have thought that the majority of the Fed chairs would be stating 1 cut between now and then, because I think most of us agree, and it's close. I mean, we've gone from a 62% to 70%. I don't think 2 cuts is going to happen. That 13.3% probability seems very, very low. But I agree with you. 1 cut between now and the end of January seems highly likely. Hey, Matt, what happened the last 2 times the Fed cut rates? What happened to mortgage rates?
Oh, I remember specifically September 18th. That was a fun day. The Fed cut the Fed funds rate by 50 basis points. And like we just saw in that chart, that was the start of the upward spiral in mortgage rates. So rates went up like a full percent the 4 weeks following. So Fed rate cut does not equal a cut of mortgage interest rates. They'll pay you less on your savings accounts, and you might get a better rate on your credit cards or other types of debt, but it's not directly tied to mortgage rates. So let the news do their newsing and let people continue to reach out to knowledgeable mortgage brokers like the two beauties that are on the screen right now. And
There's
say,
someone
oh,
else
I heard
in
that
the
the Fed
chat.
cut
No.
mortgage rates. What do you got for me, Matt?
Yeah, I think that we should continue to expect that as things move. I mean, the mortgage rates are going to move a lot more, after JP speaks, after we get more data. It just doesn't seem to be impacted very much. As long as the Fed does what we think they're going to do, bonds will react appropriately. And we're not expecting any decent movement. It doesn't make sense to be like, well, let's hang out and see what happens on December 18th. Well, it hasn't worked out in our favor the last couple. Let's move to the last slide here. I think it may be last. We're probably looking at the March meeting. So this is where, we're still fairly consistent on 1 to 2 moves. It doesn't really matter what the March chart looks like, in my opinion. We're too far away from it. There's too much stuff happening between now and then with the changeover in the administration, too many things in the news cycle. My opinion is just the March chart just doesn't really matter right now. But what do you think, Matt?
Yeah, I agree. There's going to be months and months of data and reports and discussions between now and then. And to think that we know what the jobs report will say, this week or next month is crazy. Tell me what the jobs market's going to look like in February of 2025. None of us really know. So yeah, this stuff is still all dependent on what data comes out between now and then.
Yeah, agreed. So I think we can move on from our target charts here and let's talk about news this week. What do we have going on? What do we need to be looking out for? What is interesting? Jumping in and just looking at the weekly schedule of financial data, the big thing that jumps out to me is the dude himself, Fed Chair Jerome Powell, is speaking Wednesday afternoon. It's going to be boring. He's not going to say much, and everyone is going to react and then overreact again based on whatever he has to say. So I think Wednesday is going to be a very interesting day. It's not going to be coupled with a ton of data that day. We've got S&P Global Services PMI, which has been pretty consistent. We've got the ISM Manufacturing PMI for November. Target is to remain very, very consistent on those two things. Jolt's job quits on Tuesday is going to be kind of cool, possibly. Could move things a little bit. We have 2 members of the Fed speaking on Tuesday, Kugler and Goldsby. Probably not moving much. Just looking down the MBA purchase and refi indexes will be interesting on Wednesday just for us to see where things are going in our industry. Probably not moving anything. Jobless claims on Thursday, though. That's a good one. We've got a pretty big needle on those plus continued claims. The last jobless claim numbers were inconsistent. We were a little bit lower on new claims, but a little higher on continued. So it just considered itself a mixed bag. I'm going to say outside of Powell, the biggest news this week is going to be non-farm payrolls for November. I think that's going to be the big kicker. Do you remember what happened in non-farm payrolls last month? Came in over 200,000 lower than expectations. It was 12,000 jobs added. We are forecasting 195,000 added. That's going to be pretty interesting to get those unemployment numbers on Friday. What do you think about this week's schedule?
Yeah, I mean, I agree that between Jerome being Jerome and saying the same type of stuff, which I don't blame him. Like he's got to say that we're going to continue to monitor this, and this is our dual mandate. Outside of him saying anything, dramatic about like what the Fed plans to do in the future, that payroll stuff is important. And I think, for a layman like myself, and for most people, like I wouldn't concern yourself too much with these numbers. There's all kinds of ways in which you look at it. And you're like, how do they calculate this? Do they use, seasonal jobs in here? And then they go and they revise them. But, that's the one, if anybody's like wondering, like that can probably affect mortgage interest rates the most, whether that's a hit, a miss, an overstate, because like you said, when it came in at 12K, we're expecting 200K. That is something that affects mortgage rates. Before we roll, man, I want to make sure we save a little time for Q&A. Jay Homeboy asked a good question. If anybody else has questions, feel free to drop them in the chat. I want to hear your take on this, Nash, because, being a loan wizard, you're a loan wizard for origination. You're a loan wizard for what happens post-origination with servicing and such. So what's your take on why don't loan origination companies keep the loans? And I think, Jay Homeboy, maybe you want to rephrase like keep all the loans. How much do they make when they sell the loan to investors?
So great question, and a very interesting one. And thankfully, I've worked in all three channels of the mortgage industry. I've worked for banks, I have worked for correspondent lenders who are direct seller servicers, and I've worked for brokers who can send their loans anywhere. Excuse me. So it's all a matter of what function makes the most sense. When you're a seller servicer, you make your money off servicing. Think Quicken Loans. Think, even a bank like Chase. They're going to keep most of their stuff in-house. They're going to make money on servicing. I'll tell you this much, there's not a lot of revenue in servicing. These loans, you're not using your own money to back them. Generally, they're being sold off to Fannie Mae, Freddie Mac. Ginnie Mae is backing these. You get a very small percentage for servicing, but you have to allocate a significant chunk of resources and manpower in order to manage that servicing. Like servicing is a big deal. You've got to have lots of people in there with customer service, answering phone calls. You've got to have significant credit lines. It costs a lot of money to service your own loans. And so when you service your own loans, you're paying more. When I worked for correspondent banks that service our own loans, or even when I worked for the big banks that service their own loans, my pricing was higher because we had to allocate for the additional resources. It makes a lot more sense for the consumer's perspective to work with an independent mortgage broker because we are going to shop that deal to anyone we want to. And let's say UWM or PennyMac or PRMG or AFR, whoever happens to have the best pricing on that day and they want to service it. Cool. Awesome. So they're going to take the mortgages that they service. They're going to usually trade. It's almost like trading stocks. They have these loans that they have locked in interest rates for, that they've guaranteed delivery to Fannie Mae, Freddie Mac. They hold on to them. They see how the pricing changes on the mortgage-backed securities before they get bundled and sold. And they know, hey, I can make a little bit more on the back end here. And that's why some of the most successful seller servicers have fantastic operations team on the back end that monitor their pricing. So that way they can make some money on the back end as well as selling those off. There's a huge drop in interest rates and they're sitting on all this stuff that's written at a higher spot. Cool. They're going to make more money on selling the servicing rights. But if we have a big change and things go up, they're not going to be able to sell those 6.75s for what they could before. Now they need to be bundling things like 7.125. So it's a kind of a risky game that they play on the back end. And because of that, most seller servicers have to hedge enough money in there to make sure that they can withstand any kind of market movement. So the long and the short of it for that is it makes sense. You got to have people that are servicing loans, but taking that risk out of servicing, not having to have the manpower for that, not having to deal with bundling those into mortgage-backed securities. That's why an independent mortgage broker, on average, historically, is able to get better pricing for their consumers because someone else is taking on that additional risk and they're built to have that manpower to do that well.
Well said, brother. Yeah, not much to add, but when I look at it, a company like UWM's doing $100 billion in loans. They're not going to service every single loan, for the rest of time. They have to, I think part of it's, cash flow management and whatnot as well. Like you sell that stuff, get it off your books, originate more. And the good news is for consumers, like servicing loans isn't that hard. Most servicers do it well. One thing I'll remind people, because I've got multiple mortgages, investment properties and whatnot, and multiple ones of them all went to the same place, Mr. Cooper. I think Mr. Cooper is a phenomenal servicer. They can collect payment. They can apply payment. Their portal's easy to use. If I've ever needed customer service, I've been able to get in touch with somebody. But servicing is a different game than origination. And so, whether it's your next purchase or your next refinance, you get a call from the servicer because they have your contact info because they're servicing your loan. You still want to talk to an independent mortgage broker and say, hey, listen, I'm thinking about refinancing. Does it make sense? My servicer told me this. A lot of times, like I've just heard stories, Mr. Cooper and Flagstar and others, where they just completely fumble because they might be the number one servicer in the country. It's a different game than origination.
But Matt, they already have all my information. Doesn't that save me 30 seconds of data collection?
All your information is, 6 documents in a Dropbox that you can send right over, and me or Nash,
Wait,
you will get you a better deal.
so are you saying just because I'm already with them, they're not going to instantly give me a better deal? Because it should cost them less to originate that loan because it's already there. So
Dude,
shouldn't
we
it
could
be
do we could
cheaper
do
if
a
I go
whole
back to them?
show. We could do a whole show on cheesy sales gimmicks where it's like, oh, it's a streamlined process with us because we have all your information. I'm going to give you a free refinance. Man, I want to do a whole series on fake marketing, but that's for another day.
I'm not going to act like I haven't used that line before. Like, oh yeah, we're X bank. I've already got your name, address, and information here. So yeah, sure. Of course it'll be easier and quicker to go with us. Yeah, I've been that guy before. My bad, y'all.
You know what? Maybe I've said we've already got a full arrive file, but the truth is, it is easier with professionals because professionals know what they're doing. And, like I had a conversation with a client last week. All we do all day, every day is mortgage. There's no other focus. I'm not doing car loans. I'm not doing CDs. I'm not doing, business accounts, mortgage origination all day, every day. That's what we're doing. So thanks for the good chat, Nash. It was good seeing you. Happy Thanksgiving to you and your fam. If I didn't get it in last week.
Yeah, no, it's been a good time. I'm looking forward to coming back next Monday and going over all the fun stuff that happened this week and seeing where things are. If you're a professional in the industry right now, like Joe said, and if you like it, lock it. There's a lot of stuff that can move the needle. Nothing that says it should move one way or another. There's smarter people than us that are moving things in all these directions. So, y'all go out there, write some loans, help some people, and do the right thing.
Cool. Thanks, buddy. See you next week.
Yeah, man. Take care.